Good morning, everybody. Hello, and welcome to another edition of your Bitcoin Economic Calendar, the research and analysis you need to know for the week ahead in Bitcoin. Today is Monday, December the 21st, and we have a very special Christmas edition of the calendar for you today with lots to cover. Last week, we announced our savings accounts interest rates effective as of January 1st, 2021. Today, we're going to be breaking down the market dynamics that drive those interest rates, how are they set, and why they may change. We're also going to be breaking down the two reflationary trades that we're seeing in the equity markets right now. Those are the vaccine-induced reflationary trade versus the stimulus-induced reflationary trade, what the two differences are and how that may impact markets. And we're also going to be talking about the potential future institutional catalysts for Bitcoin in the weeks ahead. This and more in today's analysis. So to start today, we wanted to do a quick recap of the rates that we announced as of January 1st, 2021 for our savings accounts. As you can see in the back of my screen, the new rates will be 6.25% APY for Bitcoin and 12.25% APY for USDC. Now, once again, we're going to be going into the market dynamics that drive these interest rates in today's market trends section. Moving over to Bitcoin, happy all-time high, everybody. In movie-like fashion, last week saw even more institutional activity than ever before, and we finally got the rumored regulation out of the US, which, as presented, does not pose the impending doom of self-hosted wallets that many thought could be coming. Lots to cover again, but first let's start with the news from Guggenheim, which you see in the back of our screen right now. And essentially, what that was that it was basically Guggenheim going on national television predicting a price for Bitcoin of $400,000 per Bitcoin. On Thursday, Scott Minerd, Chief Investment Officer at Guggenheim Investments, said, "Our fundamental work shows that Bitcoin should be worth about $400,000 on Bloomberg." The price prediction caused Bloomberg's production team to pause the transition to a press conference by the Fed's Jerome Powell. I don't think Bitcoin has ever seen such a bullish call from a Twitter anon, let alone from one of the world's greatest institutional investors. The decision to stay with Minerd and not transition to the Fed's press conference was a very strong signal. A Bitcoin price prediction was more important than an update from the Federal Reserve in the middle of a crisis. Now, later on Thursday, we saw the news that Coinbase was basically planning to go public, and it has taken the first step in that process by filing an S-1 registration with the Securities and Exchange Commission. This most likely will act as a catalyst for the entire industry as investor appetite seems to be heating up, not just for the protocol assets, but also for equity in companies that are building the new financial system. Then later on Monday, which is the next screen that you have the next piece of news that you have on the screen right now, essentially, as we mentioned on the last Monday, it was widely anticipated that the regulation was going to come out last week, and it did on Friday. So in very unusual fashion, the Department of the U.S. Treasury published a proposed law and is only allowing for 15 days for comments in the middle of the Christmas holiday and in the context of an administration that has days left in its mandate. Now, under the advance notice of proposed rulemaking, users who would want to send cryptocurrencies from centralized exchanges to a private wallet would need to provide personal information about the owner of the wallet to the exchanges, if the amount sent is greater than $10,000 in one day. The exchanges would also need to submit and store records involving such transactions with a total value over $10,000 in a given reporting period, or just maintain records of transactions over $3,000. Again, the rule does not outlaw privately holding Bitcoin for US citizens, but it could severely affect a user's ability to interact with smart contracts and P2P platforms that do not collect this type of information. Now, going back to the chart, we see that Bitcoin essentially closed one of the most important weeks in its history, up 20.93% to a weekly close of 23,733. Apologies. We'll cover what we can expect in the coming weeks in our What's Ahead section later today. Now, moving over to the S&P 500, we see that it also closed the week at a new all-time high of 3,722 points, up 1.25%. And this was on the back of a very dovish Federal Reserve press conference and the forming narrative that the Federal Reserve is now switching policy gears from stabilization policies to accommodative policies. Now, what does this mean? It means that the consensus view is shifting from a stimulus-based recovery to a vaccine-driven activity recovery. While both trades are reflationary, the groups that stand to benefit vary widely. And these views have been expressed in the markets recently, as we can see from comparing the performance from the stay-at-home trade. We're going to use Amazon and Facebook for proxies versus the economic activity trade, which will use Disney for parks, Tesla for renewed vehicle demand, US Steel for manufacturing, and Macy's for consumer spending. Now, let's take a look at those stocks. First, let's look at the stay-at-home trade. We'll see Facebook for a second. So we can see that Facebook, as of July, has been somewhat range-bound. It hasn't really broken off the new highs. Let's take a look at Amazon. We see similar trends here in Amazon. It's been basically range-bound since July. It hasn't come down, same with Facebook, but it has not basically elevated to new highs. Now, let's compare those to the economic recovery trade. Let's look at Disney. We see Disney has moved significantly higher since July. Now let's look at Tesla. Again, we see that Tesla has again also moved significantly higher since July. Let's look at US Steel. Again, US Steel has moved significantly higher since July. And if we want to add Macy's, just quickly to take a quick look, we see again that Macy's has considerably moved higher since July at 6 levels, now sitting around the $10 level. So this is essentially, we can expect this to continue, as the Fed has said that it will not try to dampen the economic recovery this time around. And this setup is actually creating other very interesting dynamics in emerging markets that we will cover in the next issue. Now, another important thing to cover is that there was a last-minute stimulus deal reached last night, which will be sending $600 stimulus checks to Americans. So look for the stay-at-home trade to possibly look for another leg up, while it will likely keep sending the markets higher in the coming weeks. Now, moving over to gold, we see that we're seeing signs of life again on gold, with it closing up 2.28% last week to $1,880 per ounce. This was likely on the back of better than expected economic data coming out of the United States, the vaccine in the horizon, and the monetary supply and monetary velocity dynamic that we were covering in the last BEC. It would be rare to see gold come down from these levels given the current backdrop and the seemingly very low risk of a strengthening dollar. Now, moving over to the DeFi index, we see that once again, as we highlighted in the previous week, it underperformed the protocol level assets to the upside. The index closed last week up 5.61%, as we can see here from this chart. This is the last week, 5.61%. And that was well below Ethereum's 8.12% rise and Bitcoin's 20+% rise. So we see that it is significantly underperforming the protocol level assets, and the regulation out of the US as proposed could pose significant headwinds to the usability of smart contracts and decentralized exchanges in the United States. While some market participants may have already been pricing this in, now that the news is out in the public, this may lead to more decisions to divert away from the space until the scope and impact is better assessed. So it will likely continue underperforming the protocol level assets in the weeks to come. So in today's market trends section, we're going to be diving into the dynamics that drive the interest rates for crypto savings accounts. So to start, the biggest driver of any market is supply and demand. We will be diving deep into the demand side of Bitcoin and USDC borrowing in this issue. But in principle, a large driver of this dynamic is the speed at which the number of people and Bitcoin looking to earn interest is increasing. This, combined with current market dynamics, have put some upward pressure on dollar rates and some slight downward pressure on Bitcoin rates. So to start, let's break down the use cases for institutions borrowing USDC and Bitcoin. Broadly, there are 4 buckets for institutional use cases for borrowed Bitcoin and USDC. The demand to borrow these assets can vary depending on market conditions. And first, let's identify what those 4 main use cases are. First would be borrowing Bitcoin to short, whether that is a directional short or a hedging short. We'll be diving into more detail on that shortly. The second one would be futures curve arbitrage, which is a price neutral strategy for which you borrow Bitcoin. The third one are other price neutral strategies to borrow Bitcoin, like the GBTC example that we're going to be going over. And lastly, there is demand for dollars to get more long exposure to Bitcoin and alternative digital assets. So now let's break down these buckets one by one. Okay, so first let's break down the short dynamics. The chart that you're seeing behind right now in my screen is the long short interest for the exchange Bitfinex. And we're going to cover what this is showing us shortly. But broadly speaking, there are two types of investors that look to take short positions on Bitcoin. One would be directional shorts, those who believe that an asset is overvalued relative to others. And the other one is hedging shorts, people that have a large amount of Bitcoin and want to neutralize their current profit and loss for a particular reason. Now, there are many data points to reference that interest for shorting Bitcoin is near all-time lows. And that makes sense, given that both types of investments have reduced demand in the current environment. The Bitfinex Long Short Index that you're seeing behind the screen is a good heuristic. And we can see from this graph that the short interest is actually at all-time low levels. This is not surprising. It's not surprising, that shorts are covering in this environment. For directional shorts, the momentum is very strong to the upside. The narrative is continuing to build, with many, like Guggenheim, saying that Bitcoin is critically undervalued at current levels. Additionally, many hedging shorts would be looking to cover for the same direction. They wouldn't want to block themselves from potential higher profits. And the other strong factor for both is that at the end of the year is a great time for accounting reasons to close losing trades. So that's the dynamics on the short side of things. And as we can see, the demand for this is at all-time lows. Demand being at all-time lows for this type of borrowing from institutions puts downward pressure on the borrow rates that they can pay. Now, second, let's talk about future curves arbitrage, the Bitcoin futures curves arbitrage. And I will go over the graph you're seeing behind me shortly and what it means. But the steepness of the futures curves changes with market moves. What gives a curve its steepness is the difference in price that investors are willing to pay for future Bitcoin over current Bitcoin. Broadly speaking, parallel to the rise of people looking to earn interest on their Bitcoin, there has been huge growth in the amount of institutional grade desks that are being set up to take advantage of market opportunities of abundant Bitcoin and steep futures curves. Now, let's go over how this trade happens. To enable this trade, participants need to borrow Bitcoin to sell the long-dated future, which is usually trading at a higher price, while simultaneously using those proceeds to purchase Bitcoin at the current price and deliver it when the contract comes due. By doing this, they can collect the difference between the future price and the current price after repaying the borrowed Bitcoin plus interest. So, if we divide the profit that they make by selling the future and buying the current spot and holding that for that amount of time, we can get an effective interest rate for that Bitcoin. Now, let's see what the annualized platforms in some of these, annualized rates in some of these platforms are, which is actually the graph that you're seeing behind your screen right now. What this graph is telling us is that in the December maturity, Bitcoin is trading slightly higher than spot. At the March maturity, it is trading at around 5% average from spot. And in the June maturity, it's trading at about 7.5% over spot. We can also see that the steepness of these curves vary greatly depending on the platform. Mind you, the CME data was taken last night, so that might have affected some of the quotes. But broadly speaking, we can see that there is more opportunity in some platforms over others, and this is also a function of how many institutional participants are looking to arbitrage these opportunities in these particular platforms. So that broadly covers the current setup of the futures curves and what the opportunities and how those may change. So next, we're going to cover other price neutral strategies for which institutional participants are borrowing Bitcoin. A popular one being the GBTC Premium Arbitrage, and we're going to break that down here. So in order, a popular trade, like I mentioned, is to borrow Bitcoin to contribute it to the GBTC fund in kind to get shares for the fund. Then you can essentially sell the shares, get the dollars, purchase the Bitcoin back, repay the loan, and capture the premium. So how does this work? Well, let's cover a few things first. Current contributions to GBTC are averaging about $1 billion per month. A lot of these contributions are Bitcoin in kind, contributions of investors that are trying to take advantage of the current premium between the price of Bitcoin on spot and the price of GBTC shares. So as you can see from the chart behind me, there is a set price for Bitcoin. There is also a set price for shares outstanding in the fund, and there is a set number of shares in the fund. So these two numbers can vary, with the shares of the fund in dollar terms being priced higher than the total number of Bitcoins being held in the fund. So what that creates is a temporary situation where your share of the fund is worth more than the value of the same amount of Bitcoin that share represents. So in theory, what investors can do is contribute the Bitcoin to get the respective proportion of shares, which are trading at a higher dollar price than that actual Bitcoin. So then you sell the shares and buy that equivalent amount of Bitcoin, and you get to keep the difference. So as if we can break this down, but essentially once you do that, you get to see that the current premium on GBTC is currently sitting at around 38.21%. Now, this is not necessarily to say that this is just free money. There are risks associated with these trades, even though they are price neutral. So let's go over a few of those. So one very important thing to mention is that it takes 6 months for Bitcoin to get converted into shares. So investors have to essentially wait for that period while their shares are given to them, and only then they're able to sell them to repurchase that Bitcoin. What does this mean? It means that this premium can essentially, the size of this premium can shift in that 6-month term. And if investors are looking to sell those shares in the future and that premium is not there anymore, their profit can essentially get squeezed out. So again, while these strategies, this and others, are price neutral, there are some risks associated with the potential trade, and investors exercise caution, especially when just holding Bitcoin can provide such attractive returns given the current setup. Now, and lastly, let's talk about the long exposure and demand to borrow dollars to get more exposure to Bitcoin and other alternative digital assets. So in bull markets, the demand for dollars goes exponential as people look to borrow dollars to buy more Bitcoin and alternative digital assets. This larger demand for dollars forces lenders to charge higher rates and in turn can pass more interest to USDC savings accounts. We dedicated a large part of the last economic calendar to the fact that Michael Saylor had borrowed $650 million to purchase more Bitcoin, which is a great example of people doing this. This trend is likely to continue as Bitcoin climbs higher. Additionally, whether we like it or not, there will eventually be a wave of speculative demand for alternative crypto assets, which will continue fueling the demand for dollars, which again allows lenders to obtain higher rates and thus pass on a higher interest rates to our USDC savings accounts. So to summarize everything we've covered today and to paint things perhaps in a slightly different light, yes, there are market opportunities that allow institutions to borrow Bitcoin, earn a profit, and allow us to pay our savings accounts clients great rates. But as we have seen recently, few market opportunities outperform just buying Bitcoin, which is up 20% just last week. Therefore, market participants favor borrowing dollars to buy more Bitcoin and digital assets in conditions such as the current one. In sideways or down markets, the demand to borrow dollars tends to be lower, and the demand to borrow Bitcoin to hedge positions tends to increase. These market dynamics have led to our rates being set at 12.25% APY for USDC and 6.25% APY for Bitcoin. Now moving over to our Bitcoin mining difficulty commentary, not much has changed on the difficulty front. We're still holding strong at 18.67 terahashes. The next difficulty adjustment is looking to come in relatively flat, currently showing an increase of only 0.45%, and it's still on track for next Sunday. So as always, we leave you with our what's ahead for the week section. And vaccines are rolling out, and the prospects of an economic rebound in 2021 are looking increasingly more likely. The narrative continues to build with the underlying driving factor being dollar weakness. With the Fed switching from a stabilizing stance to an accommodative stance, they won't be looking to front-run inflation, even if it starts to creep in. This means a continued prolonged period of low interest rates, and if you couple that with the new $600 stimulus check for Americans, you have yourself an inflationary cocktail. This will likely keep driving dollar-denominated markets higher. On the Bitcoin front, the narrative seems to be quickly switching from Bitcoin as a novelty asset to you don't have Bitcoin in your managed portfolio. And as we get to the end of the year, we may see more money chasing Bitcoin, and it may be the reason why we have not yet seen a significant dip. We're starting to see the shades of that this morning, even after rocketing through all-time highs. The following weeks will be big tests for Bitcoin. However, there is a bit of a perfect storm at the moment, with buying pressure only growing, and they are investors likely hunting for a dip. Now, to cap it off, we will likely be hearing more details about Coinbase's IPO as it prepares to go public, which may act as a catalyst or as catalysts for the entire market. Coinbase has to create hype around its offering, and this will act as PR for crypto assets and the investment community. We'll keep an eye on these announcements, and we will essentially keep you informed if and when more institutions or corporates jump in. And finally, while there is a lot of attention on price, we'd like to share our thoughts on the proposed law out of the US Treasury. While we understand the regulators are looking to protect consumers, allowing only 15 days for consultation in the middle of the holidays does not quite seem like the appropriate consideration for such a meaningful law. While we are not a US entity, we will support our peers in their commentary and participation for their proposal, or for this proposal rather. Our legal counsel is doing a full review, but as per our current understanding, this would not materially impact how Ledn interact with its US clients, other than some additional reporting requirements for withdrawal values to be determined. As always, we will keep you posted of any relevant news and information throughout this week from our Twitter accounts at Huddle with Ledn. Thank you very much, everybody, for tuning in. Have a great week. Merry Christmas and happy holidays from us and the team at Ledn. If you don't yet have a Ledn account, check it out and learn how you can start earning 6.25% APY on your Bitcoin as of January 1st and 12.25% APY on your USDC as of January 1st. Thank you, everybody. Have a great one and see you next Monday.